Welcome to the Deep Dive, the show that takes high stakes, small cap companies facing massive market volatility and extracts the clear, actionable understanding you need.
Today, we're tearing into the core operations and financials of Richtech Robotics, or RR. This is a company attempting to solve one of the most critical structural issues in the global economy right now.
That's the crippling labor shortage and the expense crisis that we're seeing across the entire hospitality sector.
It's a textbook example of a public company in metamorphosis. You have an industry, hospitality and leisure, that struggles with employee turnover rates that, they routinely exceed 100%.
Wow.
And Richtech's value proposition is, on the surface, very simple. Insert a fixed cost automated solution into that volatile environment to drive, labor arbitrage.
So the question we're grappling with today isn't really incremental, it's existential. Is Richtech Robotics the genuine vanguard of a robotics-driven industrial revolution for service industries, poised to capture billions in market share?
Or is it simply a capital-intensive science experiment that will burn cash until it just hits the limits of investor patience?
Exactly.
Our mission in this deep dive is pretty comprehensive. We're anchoring our understanding to the market close of mid-November 2025 to assess a company at its most critical juncture.
And this isn't just about managing market expectations.
No, not at all. They are executing a fundamental pivot in their entire business model, shifting from selling products to selling service subscriptions. So we have to look closely at the business strategy, the detailed financials, and of course, the significant risks involved in that exact transition.
And the whole story, really, is wrapped up in one massive, frustrating financial paradox. This is the tension we want you to keep in mind throughout this deep dive. On one hand, the company's internal economics are, well, they're stellar. They report a gross margin of roughly 76%. That number tells us the product itself is incredibly valuable and profitable to make and service.
But on the other hand, the operating margin is a staggering, cash-consuming negative 395%.
It's an unbelievable number.
They are spending nearly $4 for every $1 of revenue they bring in today, just aggressively burning cash to chase a growth vision that may or may not materialize.
And that extreme divergence between the product profitability and the operational expense is precisely why the intrinsic valuation range is so vast.
It's huge.
Our analysis shows a bear case hovering somewhere between, say, $1.50 and $2 per share, but a bull case that stretches all the way up to $5 or even $6 per share.
This isn't a stock in the traditional sense. It's truly a public market venture capital bet. And we are going to unpack the details that make that potential payoff so dramatically wide.
Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. So let's unpack this business model. To really understand Richtech Robotics today, we have to start with the fundamental strategic shift that has been underway since late 2024 and really accelerated throughout 2025.
This is the metamorphosis. The move from selling traditional hardware to selling robot as a service, or what everyone calls RaaS.
And this pivot is absolutely crucial for grasping their current volatility, right?
It explains everything. Historically, Richtech generated revenue the old-fashioned way. They manufactured a robot, they sold it for a lump sum, say $180,000 for a complex unit, and they recognized all of that revenue immediately under GAAP accounting rules.
Which gave them these high spikes of revenue when they shipped a big order.
Exactly. But the RaaS model just flips the script. Instead of the client buying the robot outright for a lump sum, the client leases or subscribes to the service provided by the robot.
So Richtech keeps ownership, they handle the maintenance.
And they recognize the revenue ratably, meaning, monthly, over the life of the contract, which is typically 3 to 5 years.
Think of it like a business moving from selling a house instantly for a huge payment to renting that house out monthly for the next, 5 decades.
It's a perfect analogy. The cash flow profile changes entirely. It's a classic long-term strategic move because recurring revenue is predictable, it's valuable, and it warrants much higher valuation multiples on Wall Street.
But the short-term cost is
an immediate negative consequence, the optical air pocket. Because they are deferring that $180,000 lump sum into small future monthly payments, their reported top-line revenue contracted significantly across fiscal years 2024 and 2025.
So on paper, the company actually looks smaller today.
Right. But the promise is a much stickier, more predictable business model tomorrow.
And they aren't just changing how they sell the robots, they're fundamentally changing where they operate them. This is where that vertical integration strategy comes in, through the franchise brand called Clouffee Tea.
Yeah, this part is fascinating because it makes Richtech an operator, not just a vendor, which is risky, but potentially very lucrative.
How so?
The Clouffee Tea franchise model gives them three distinct integrated revenue streams. First, you have the initial franchise fees paid by the new operator.
Standard stuff.
Then you have the ongoing royalty payments, usually a percentage of that location's gross revenue. But the critical third stream is the mandatory sale or long-term lease of the robotic equipment itself, which is, of course, Richtech's core product, Atom.
So they create a captive, guaranteed customer base for their own robotics.
Exactly. They control the technology and the environment in which it's used, which lets them prove the efficiency model to other potential customers.
Let's talk about those products, because this is where all the excitement and the market buzz is really generated. Atom is their flagship, right? The dual-arm system.
That's the one. Atom is their high-value, high-cost unit. It's priced around $180,000, and it's designed for sophisticated tasks like preparing specialty coffee, mixing cocktails, or even grilling.
It's targeting those high-friction tasks where human labor is either too expensive or just too inconsistent.
Precisely. Its dual-arm configuration allows it to mimic human dexterity in these controlled environments, which is a key technical hurdle for a lot of robotics companies.
And Atom had that massive, probably unrepeatable brand awareness catalyst earlier this year.
The feature on Keeping Up with the Kardashians.
Yeah, that's the kind of high-profile pop culture validation that, traditional industrial robotics firms could only dream of.
And beyond Atom, they have a dedicated working portfolio. You've got the Matredi and Matredi Plus.
These are the AMRs, the autonomous mobile robots.
Right, and they're dedicated to food running and busing. These are really the workhorses. They handle the dull and dirty jobs, physically transporting heavy trays from the kitchen to the dining room, or hauling those cumbersome, heavy bus tubs back to the dish pit.
Then you have the more focused system, Scorpion.
Scorpion is their specialized single-arm bartending system. It's optimized purely for speed and perfect consistency in really high-volume settings in casinos, stadium bars, cruise ships.
So it proves they can tackle both the complex manipulation with Atom and the high-speed throughput with Scorpion.
Exactly. But the real vision for the future, and the magnet for all that R&D spending we talked about, is the dissect robot. It was just unveiled in late 2025, and it's their big jump into the humanoid form factor.
This is their massive technological differentiator.
It is, and it's the reason why they need that aggressive R&D budget. DX is powered by NVIDIA's Jetson Thor platform. And you need to understand, this is not just a standard CPU.
Yeah.
It's a specialized high-performance computing module designed specifically for cutting-edge robotics.
So why does that matter so much?
Because the Thor platform enables the real-time, low-latency control and the physics simulation that you need for complex humanoid tasks. Older systems suffer from latency, which means a human-like robot can't react quickly enough to unexpected variables, like a dropped object or a shifting load.
I see.
The Jetson Thor investment signals their intent to move beyond just fixed-function automation toward general industrial tasks that require genuine human-like mobility and split-second adaptability.
Okay, so if the robots are the muscles and the arms, what's the brain and nervous system connecting this whole diverse fleet?
That would be the ACP platform, the Advanced Cloud Platform. This is their proprietary AI-driven cloud platform. And this software layer is the crucial lock-in for the RaaS model.
So this is what creates the switching costs.
Absolutely. It allows large enterprise clients, let's say a chain of 50 hotels, to manage their entire deployed fleet, conduct predictive maintenance, analyze workflow data, and optimize robot utilization across all their different locations.
And once a client integrates their whole operation around that data stream, it becomes prohibitively expensive to switch to a competitor.
That's the software moat.
Let's look at their current scale. They're still a pretty small player in what is a massive industry, right?
Oh, absolutely. As of mid-2025, they had deployed approximately 400 robots, which was up from about 300 earlier in the year.
So the technology is proven through these high-profile pilots. We're talking Walmart, the Vegas Golden Knights, the Texas Rangers baseball team, but 400 units is still a modest fleet.
It is. Mass adoption is clearly still in the very, very early stage. Their success hinges entirely on converting these pilots into massive multi-unit enterprise contracts.
And we mentioned the core economic argument is labor arbitrage. Just how big is the problem they're trying to solve here?
It's a structural crisis. The U.S. leisure and hospitality sector lost over 600,000 workers during the pandemic and has just struggled desperately to recover. They were still trying to hire nearly 1 million people in early 2025.
So for many operators, automation isn't just about saving money anymore.
No, for many, it's about having reliable staff, period. Richtech's pitch is that their robots are force multipliers. They handle the physical strain hauling 30-pound bus tubs, delivering food, and that frees up the human staff for the high-value customer interactions, which is what humans do best.
But they are far from alone in this space. Who are the key competitors that are keeping management up at night?
The competitive landscape is intense, and it's being spurred on by these macro tailwinds pushing the hospitality robotics market towards an estimated, $65.4 billion by 2032?
That's a huge number.
It is. And their primary, most formidable rival is Bear Robotics. Bear recently secured a $60 million Series C funding round, and critically, it is backed by LG Electronics.
Which gives them incredibly deep pockets and manufacturing expertise.
Exactly. They're valued at roughly $500 million privately, and Bear poses a serious strategic threat because LG can essentially subsidize market share growth if they choose to ignite a pricing war.
And we have to consider the other specialized segments, too.
Precisely. You have Serve Robotics, SCRV, which operates in the last-mile delivery space and trades at these hyper-premium price-to-sales multiples, sometimes over 200x. It just reflects the sheer hype around logistics tech.
And the incumbent.
That would be Relay Robotics, Savioki. They're the incumbent in the hotel delivery sector, having completed over 1.5 million deliveries. That operational volume establishes a high barrier of trust, of reliability, and integration into existing hotel infrastructure that is just difficult for a new player like Richtech to immediately overcome.
Now, let's talk about the non-technological barriers to entry. Because it's not just about building a better robot. The RaaS model itself creates these enormous financial and logistical hurdles.
It creates a logistical moat. First, RaaS is balance sheet intensive. Richtech has to spend the capital upfront, say $100,000, to manufacture and deploy the robot fleet.
And then they have to wait 3 to 5 years to get that cash back through the lease payments.
Which requires substantial capital. Second, they need a robust national support infrastructure. If an Atom robot breaks down during the Saturday morning coffee rush, the client can't wait 48 hours for a fix.
No.
Richtech needs to build a dedicated maintenance network capable of achieving critical response times, often quoted as under 4 hours. That means maintaining spare parts inventory, training field service engineers, and managing logistics across potentially hundreds of locations, a massive, costly logistical undertaking that small startups can rarely manage.
So conversely, what are Richtech's key competitive advantages right now beyond that temporary celebrity hook?
Well, the brand strength is actually quite resilient, thanks to the high-profile pilots and that early market recognition. But the two structural advantages are, I'd say, technological and geopolitical.
Okay, let's break that down.
Technologically, the specialized NVIDIA Jetson Thor integration into the DX robot gives them a high-end advantage in the generative AI arms race. It positions them for complex industrial applications that competitors might miss.
And the geopolitical angle is perhaps the most unique asset they hold right now. It basically turns a potential trade war into a competitive edge.
It's a powerful hedge. Richtech's decision to centralize manufacturing and final assembly in Las Vegas creates a strategic moat against rising tariffs. If the U.S. imposes heavy duties, we're talking potentially 25% to 100% on fully assembled competitor units imported from overseas.
Richtech's domestic assembly allows them to just avoid those tariffs.
Exactly. They can maintain that stellar 76% gross margin while potentially undercutting foreign competitors on the final pricing. Furthermore, the Las Vegas assembly allows them to bid competitively on government or corporate contracts that require made in USA or assembled in USA mandates.
This strategic advantage is going to be central to our risk analysis later on. But we've established the core business and the fact that the unit economics are fantastic, yet the operating costs are consuming all the profit. That brings us squarely to the leadership team. Who is driving this bus? And, more importantly, how are they paying for the fuel? Like and subscribe to Stock Analytics AI.
For $4.99 month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Chapter 2, Management Evaluation. We shift now to the leadership steering this very complex, high-risk pivot.
The company has been led by Zhen Wu, or Wayne Huang, as CEO and co-founder since 2016. That provides over 9 years of continuity. What does his track record tell us about how he manages crises and allocates capital?
It tells us he adheres to the classic Silicon Valley philosophy. Prioritize aggressive expansion, technological leadership, and market grab over any kind of short-term profitability.
So his background is in innovation, not necessarily large-scale public market operations.
Right. And the most revealing action was the response to that revenue air pocket we talked about. While quarterly revenue fell sharply from, $8.8 million down to about $1 million because of the RaaS pivot, management didn't panic and cut R&D.
They did the opposite.
They doubled down. They committed huge capital to the DEX humanoid R&D, scaling the ACP software platform, and aggressively launching corporate-owned Clouffee Tea locations to quickly prove the viability of the franchise model.
This is a textbook growth-at-all-costs mindset being executed in public view. And while that might be necessary to win the robotics race, it introduces massive risk and relies entirely on faith in the founder's vision.
It does. They prioritize staking out their future position in the market over mitigating the current GAAP revenue slump. Now, in terms of transparency, management has been active in communication, particularly regarding the benefits of their Made in USA positioning and attempting to mitigate public concerns over robot anxiety in various interviews.
So they are actively trying to shape the public narrative.
Yes. But the flip side of that powerful leadership style is a corporate structure that gives minority shareholders very little say. Let's delve deeply into the implications of the controlled company's status.
This is a critical governance point that every single investor needs to understand.
It is. Richtech operates with a dual-class share structure, which just means some shares carry more votes than others. Because of this, Wayne Huang, while owning roughly 15.3% of the equity directly, controls over 50% of the voting power.
And that officially designates Richtech as a controlled company under NASDAQ listing rules.
Exactly.
And what does that classification practically mean for the governance of the company and the protection of minority shareholders?
It means they are exempt from certain key corporate governance requirements that apply to typical public companies. For instance, they don't need to have a board composed of a majority of independent directors, nor do they need fully independent nominating or compensation committees.
Which means this concentration of power allows for rapid, unilateral, strategic decision-making, like the quick approval of that massive share increase.
Right. But it significantly reduces the traditional checks and balances required for transparency and accountability to outside investors. Minority shareholders are essentially forced to implicitly trust the CEO's vision and execution without traditional recourse.
Let's follow the money now, focusing on the capital allocation strategy,
Yeah.
which directly funds this high-growth mindset.
Their capital is directed aggressively toward three costly areas. First, R&D, specifically the DEX humanoid and the ACP cloud platform.
Okay.
Second, they're launching corporate-owned Clouffee Tea locations. These are essentially costly marketing experiments to gather data and establish proof of concept before they start selling franchises.
And third,
Capacity expansion. They acquired and are retrofitting a 20,000 square foot facility in Las Vegas to potentially quadruple their production capacity.
all that expansion requires a tremendous amount of cash, which brings us to the biggest structural risk management poses to current investors, the reliance on continuous dilution.
They are a net issuer of equity, not a company returning capital through dividends or buybacks. They rely heavily on at-the-market ATM offerings to raise funds.
And the announcement on November 10th, 2025 regarding dilution, that was a massive event.
A huge event. Management sought and received authorization to increase the total authorized Class B shares from 200 million to a staggering 1 billion.
$1 billion.
This isn't just a sign of future fundraising. It provides management with a virtually unlimited runway to issue new shares to raise capital to fund the negative operating cash flow.
So while this guarantees the company can keep the lights on and fund R&D,
it means the shareholder pie will be sliced thinner and thinner, constantly suppressing the value of current shares.
if we look at the return on invested capital, or ROIC, it just validates the story we've been telling about heavy investment.
Absolutely. The ROIC is currently reported at a negative 15.48%, which significantly lags the market average of around, plus 11.14%.
But you have to contextualize this.
You do. Within the RaaS model, this negative figure is expected, it's even structural, during the early J-curve investment phase. The J-curve dictates that you have to make these massive value-destroying upfront investments, building the factory, manufacturing the fleet, developing the software before the long term. Predictable cash flows from the RaaS subscriptions start rolling in years later and pull the metric back into profitability.
So investors here are buying into the future realization of that curve, not the current return metrics.
Precisely.
Chapter 3, Financial Health. Let's transition now to the core financial health of Richtech Robotics. With a market cap floating between, $488 million and $560 million as of November 2025, it's clear the market is already pricing in massive future success.
That valuation is critical context. This market cap is based on a significant growth premium. It reflects the expected $6 stock price, not the current $3 and change reality, and certainly not the suppressed current financials.
The market believes management will execute the pivot.
It does, and the revenue trend is a perfect demonstration of that rep's pivot in action.
Walk us through that steep, volatile swing.
Okay, so in 2023, largely fueled by lump sum hardware sales, revenue was $8.8 million. As the reps transition accelerated in 2024, that revenue dropped to $4.2 million.
And most recently?
For Q3 2025, the reported revenue was only $1.18 million. That's an 18.4% drop year over year. That is the optical air pocket realized. It's a painful but, intended contraction.
But the whole investment thesis rests on the analyst projection for a massive rebound next year.
Exactly. Analysts are betting that the RaaS base starts stacking up. They project a full-year FY25 revenue of $5.0 million, followed by a sharp jump to $13.8 million in FY26.
That 130% projected growth rate is the crucial variable.
It is. If they miss that target, the valuation premium evaporates instantly. If they hit it, the RaaS Smart model is validated.
Let's hit the margin paradox again, but this time, let's go deep into what is causing the massive operational loss, because this is the single most important number for you, the listener, to internalize.
Okay. We established the gross margin is about 76%. This stellar number proves that the underlying unit economics are sound. The robot is manufactured cheaply enough and least expensively enough that the cost of goods sold is small relative to the revenue generated. The product is highly profitable.
But that profitability is being completely consumed by operating expenses, leading to the operating margin of negative 395%. We need to itemize what is causing this incredible cash burn, which is housed in the SG&A line item.
It's infrastructure spending, pure and simple. This 395% negative margin reveals the crushing weight of public company compliance costs, legal fees associated with franchising, the massive R&D budget funding the DX robot and ACP platform, and importantly, the cost of scaling the support network.
The logistical moat we talked about earlier.
Exactly. That requires hiring and training dozens of field service engineers, maintaining spare parts inventory across the country, and paying for pre-revenue marketing for the Clouffee Tea franchise locations that are not yet cash flow positive. All these costs hit SG&A immediately, long before the multi-year RaaS revenue stream starts covering them.
So they are spending almost $4 to make $1, resulting in a net loss that has widened dramatically.
Correct. The net loss for the 9 months ended June 30, 2025, widened to $12.2 million. This is an aggressive, intentional burn rate that scares away risk-averse investors, but excites those looking for a disruptive growth story.
And this high burn translates directly into deeply negative free cash flow.
Yes. Free cash flow is negative $24.9 million on a trailing 12-month basis. They're investing heavily in inventory and capacity. The balance sheet is effectively subsidizing the future recurring revenue stream that RaaS promises. This is why dilution is mandatory, not optional for them right now.
But the balance sheet does offer one major strength that gives them a tremendous advantage in the current macro environment, and that is their lack of debt.
That's the saving grace. Their debt-to-equity ratio is virtually zero, reported at 0.01. Richtech has funded its operations almost entirely through equity issuance, not borrowing.
And that's crucial because in a high interest rate environment where borrowing costs are punishing,
Richtech is almost completely insulated from the interest payment burden that crushes other capital-intensive small-cap tech companies. Their capital is expensive through dilution, but their debt service is non-existent.
So if they're burning $4 to $5 million a quarter, what is their runway looking like before they have to go back to the equity markets again?
Liquidity is decent thanks to earlier equity raises. They had $32.9 million in cash and equivalents as of June 2025.
Okay.
Given that $4 to $5 million quarterly burn, they have an approximate runway of 18 months, assuming that spending rate remains constant and doesn't accelerate further with the DX rollout.
So that gives management a buffer, but it means they have to show concrete evidence of the RaaS stack growing within the next 12 to 18 months.
They do. The clock is ticking.
In terms of valuation multiples, how does this suppressed revenue and high growth potential translate when you compare them to their peers. The price-to-sales ratio is pretty telling.
Based on that depressed trailing revenue, Richtech trades at a PS multiple of roughly 79x. That is an enormous multiple. To interpret that number for the learner, a high PS means the market is betting heavily that revenue will increase 5-fold or 10-fold in the next 3 years. It reflects hyper-growth expectations.
And compare that to the hyper-premium delivery stock, Serve Robotics at over 200x, and the distressed security robotics competitor Knightscope at 3.1x. What does 79x tell us about the market's specific expectation for Richtech?
It tells us they're priced higher than traditional industrial automation, which reflects the software-like recurring revenue promise of RaaS, but they are significantly discounted relative to the intense, almost irrational hype surrounding last-mile logistics companies like Serve Robotics.
So the 79x suggests the market is willing to pay a premium for the idea, but remains deeply skeptical about execution.
Exactly, which brings us directly back to the discounted cash flow, or DCF, analysis.
The DCF model is what attempts to project the present value of all those future cash flows. Given the volatility we've discussed, the RaaS air pocket, the massive burn, what were the key assumptions used to generate that huge valuation range?
The assumptions required aggression and a high degree of skepticism. We had to assume they hit that aggressive 130% revenue growth rate for FY26, meaning they achieved that $13.8 million in revenue.
Okay.
We used a very high 12% discount rate, reflecting the extreme risk inherent in a small-cap tech stock that is reliant on continuous dilution to survive. That high discount rate severely punishes future cash flows, reflecting the market's current impatience. And finally, we assumed a modest 3% terminal growth rate, assuming they eventually track global GDP.
And the result of those volatile high-risk inputs confirms the binary nature of the company.
Precisely. In the bear case, which assumes delayed break-even, continued high cash burn, and significant shareholder dilution, the model suggests a value range of $1.50 to $2 per share. This is the valuation if the RaaS pivot stalls.
And the bull side.
Conversely, the bull case, based on a successful RaaS transition, margin stability by 2027, and achieving high utilization, spits out a value of $5 to $6 per share.
So the stock price today, hovering right in the middle around 328, perfectly reflects the market's inability to decide which outcome is more likely.
It's a coin flip in the market size.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. Let's shift now to the psychological aspect, how the market is reacting to this risk profile. And despite the messy financials we just covered, that negative 395% operating margin and the widening net loss, the analyst community remains surprisingly optimistic.
The professional consensus is a strong buy, based on the 2 analysts who cover the stock. This indicates that the institutional view is primarily focused on the potential total addressable market and the technological advantage.
And they're essentially ignoring the current cash burn.
They see it as a necessary expense for market capture.
A strong buy based on $1.18 million in quarterly revenue. I mean, are these analysts not looking at that $12.2 million net loss? Or are they truly just focused on the long term?
It's the long term. They view the current financials as irrelevant noise, just a temporary side effect of the pivot. The price targets reflect this optimism. The average target is set at $4.50, with the high target recently reaffirmed by H.C. Wainwright at $6.
So there's upside there.
With the stock trading around $3.28, that implies a potential upside of about 37% to the average target. The analysts are signaling that the risk of failure is already priced in and the rewards for success are substantial.
The retail and media narrative, however, is a classic tug-of-war.
It is. The tech media and specialized trade publications, they laud the Star Trek vision of the Dissect robot and the clean efficiency of the Clouffee Tea franchise. It's an exciting future story.
But the financial media?
The financial media focuses relentlessly on the messy transition, the revenue contraction, and most importantly, the extreme dilution risk posed by that massive increase in authorized shares.
That celebrity pop from the Kardashians was a powerful but temporary catalyst.
Right. The company requires sustained positive news flow, like a major contract announcement, to maintain momentum now.
And this mixed sentiment, combined with the volatility, is creating a potentially explosive short squeeze dynamic.
It is a significant factor. Richtech has a substantial portion of its tradable shares betting against it. The short interest as a percentage of float is nearly 14%, 13.97% to be precise.
Which indicates a very crowded bearish trade. A lot of hedge funds and sophisticated traders are convinced the dilution and cash burn will ultimately sink the stock below that $3 level.
But what happens if they're wrong? If Richtech announces a major chain adoption or genuinely accelerates its RaaS deployment, those short sellers would be forced to rush to cover their positions by buying shares in the open market.
And that sudden demand injection could trigger a short squeeze,
propelling the price violently towards that $5 or $6 bull case high in a matter of days or weeks. The current price action confirms this underlying tension. After staging a massive recovery from its 52-week low of 52 cents, the stock is now consolidating tightly in that $3 to $3.50 zone, just waiting for an undeniable sign of execution success.
Chapter 5. Ownership structure.
So let's delve into who actually holds the shares, which provides a lot of context for this volatility.
And institutional participation is notably low, which usually signals a lack of high conviction buying from large, active funds.
That's correct. Only 13.34% of the float is held by institutions. And this participation is largely dominated by passive index trackers, BlackRock and Vanguard, who are buying simply because Richtech is included in the Russell 2000 or other small-cap indices.
It's not the result of deep-dive, high-conviction active management yet.
Not at all. And this low institutional presence contributes to the stock's extreme volatility.
We also noted holdings by firms like Susquehanna.
Right. Susquehanna holds about 3.1 million shares. And in the small cap and options markets, Susquehanna is often associated with options market making, arbitrage, and hedging strategies, rather than being a pure long-term institutional investor. So that just further complicates the ownership picture.
Now, in stark contrast to that low institutional float, insider holdings are heavy. Wayne Huang directly owns about 15.3% of the equity, which provides strong alignment of interest, but
it creates a governance risk.
Yeah.
The governance risk is the primary focus here. We already detailed the dual-class structure, which means the CEO controls over 50% of the voting power. This controlled company status is a feature, not a bug, of their governance. It guarantees the strategic direction is rapid and uncontested.
But what are the implications of that concentration for the minority investor, particularly when we see reports of insider activity?
The implication is reduced corporate democracy. Decisions like the 1 billion share authorization can be passed without any typical shareholder consultation.
Right.
Furthermore, recent reports of insider selling, though sometimes explained by pre-scheduled trading plans, introduce a drag on sentiment. When the market sees the founder, who is the primary steward of the vision, selling shares, it can erode the retail investor's confidence, especially given the company's aggressive need for capital and the constant dilution threat.
Chapter 6. Risk assessment. We've established the binary outcome: immense profit potential versus catastrophic cash burn. Now we have to pull those factors together into a comprehensive risk assessment. Let's start with the classic SWOT analysis to summarize the internal dynamics.
Okay. Internally, the strengths are undeniable. The high 76% gross margins proving the unit economics are sound. The advanced technology stack underpinned by the proprietary ACP platform and that NVIDIA Jetson Thor integration. And crucially, the clean balance sheet with virtually zero debt.
Which acts as a powerful insulator against high interest rates and bankruptcy risk.
Exactly. Conversely, the weaknesses are just as sharp. The severe cash burn leading to the negative 395% operating margin, the small current scale with fewer than 500 units deployed compared to large competitors, and the limitations placed on shareholder oversight due to the controlled company governance structure.
Okay, now externally.
Externally, the opportunities are clear. The successful RaaS transition, which promises high multiple recurring revenue, the Clouffee Tea franchise model, which creates a captive integrated demand pathway, and the DX robot, which potentially opens up the massive industrial, manufacturing, and logistics total addressable market.
And the threats are fierce.
Very. We're talking about deep-pocketed competition like LG-backed Bear Robotics that could attempt to outspend or price war Richtech into oblivion.
Right.
You've got rising component costs due to global supply chain pressures and the continued sociological challenge of robot anxiety slowing down customer adoption.
Let's focus on the macroeconomic impact for a second.
Yeah.
Inflation is really a double-edged sword for them.
It is. It drives up labor costs, which increases the demand and necessity for automation, a huge tailwind for Richtech.
Wow.
But inflation also increases the cost of the globally sourced components, metals, sensors, chips that they need to build the robots, which threatens to erode that 76% gross margin. And as we mentioned, while high interest rates generally compress the valuation of growth stocks, Richtech's lack of debt entirely insulates it from the direct burden of interest payments.
We have to dedicate some extensive detail to the critical geopolitical variable, tariffs and trade wars. This is perhaps the most unique structural advantage Richtech has, but it's also a massive vulnerability.
It's a genuine wild card that could decide the market dynamics. In late 2025, the U.S. government initiated a Section 232 investigation into robotics imports, which could lead to very high tariffs and stringent import restrictions on foreign competitors.
And we already have evidence of the impact.
We do. The price of a Chinese-made G1 humanoid robot reportedly tripled from $16,000 to $40,000 in the U.S. market due to existing duties and supply chain friction.
So let's differentiate the threat from the advantage here. The threat for Richtech is supply chain vulnerability.
Exactly. While their products are assembled in the USA, they rely on a global supply chain for key components: motors, sensors, custom chips, which often originate in China. If the new tariffs are broadly applied to components rather than just finished goods, that beautiful 76% gross margin could be severely attacked as their input costs skyrocket.
But the strategic advantage provided by the Las Vegas assembly line is the ultimate competitive moat.
It is. Management views this tariff environment as potentially creating a virtuous cycle for domestic assembly. If competitors who import fully assembled robots face duties of 25% to 100%, Richtech can maintain their current margins and severely undercut the foreign competition on price.
Which means they could effectively steal market share and grow their installed base much faster than their debt-laden foreign assembled rivals could.
The tariff wall is simultaneously a shield against competition and a risk to their supply chain.
Chapter 7.
All right, it's time to synthesize these findings and crystallize the two competing theses for Richtech Robotics. Let's start with the highly appealing bull case.
The bull case argues that the painful financial metrics, the revenue contraction, the high burn, are simply temporary, necessary pain points inherent in a successful RaaS transition. The evidence is overwhelming that the core product is profitable, proven by the 76% gross margins.
And the strategic choices, like domestic manufacturing and the integrated Clouffee Tea model, are powerful hedges against geopolitical risk and competition. If management executes the projected rebound to $13.8 million in FY26, the stock, currently trading around $3.28, is fundamentally undervalued against that $6 bull target.
It's a company positioned to benefit from structural labor deficits and deglobalization trends simultaneously.
It is.
Conversely, the bear case focuses on the harsh realities of cash burn and dilution. The net loss of $12.2 million over 9 months is simply unsustainable without constant capital infusions. That reliance on equity to fund the gap is relentless.
And the authorization of 1 billion shares provides management with a clear, virtually unlimited path to constant dilution, slicing the per-share value thinner and thinner over time.
And what about the competition?
Furthermore, if LG-backed Bear Robotics decides to leverage its deep pockets and trigger a prolonged pricing war to dominate the restaurant runner market, Richtech lacks the balance sheet resilience to weather prolonged losses, pushing the stock inevitably toward that $1.50 to $2 bear target.
So after this deep dive, how should our listener categorize Richtech Robotics?
Richtech Robotics Inc. is best viewed as a high-risk, high-reward call option on the rapid automation of the U.S. service sector. It does not meet the criteria of a safe investment.
No.
It is fundamentally a venture capital-style debt made available in the public markets. The investor must be prepared to stomach extreme volatility. Swings of 50% or more are likely, and must place high trust in management's technical execution of the DX robot and their operational ability to scale the complex RaaS, Pivot, and Clouffee Tea franchise model effectively.
All while managing that immense cash burn over the next 18 months.
Exactly.
This entire deep dive started with the finding that these robots are technically capable and economically sound, designed to handle the dull, dirty, and dangerous tasks, filling a critical structural labor gap. Yet, mass adoption is still slow, partially due to what management calls robot anxiety.
That anxiety is a human and sociological factor, not a technological one. It relates to the fear of job displacement, integration challenges in a highly personalized service industry, and just simple discomfort among patrons interacting with automation.
So here's the provocative thought for you to chew on. If the technology is already proven, as the 76% gross margin suggests, And the economic necessity is already established by the labor crisis. How quickly can the human workforce, management, and the public overcome the psychology of automation?
And what needs to happen beyond just the technology and the unit economics for these robot fleets to truly scale to the levels implied by that $6 bull case valuation?
That's it for this deep dive. We hope you feel significantly more informed about the high-stakes risk and reward of Richtech Robotics. Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500+ deep dive videos on all S&P 500 stocks with NASDAQ 100 coming next, plus members-only requested deep dives.
Finally, a quick but critical reminder. This analysis was generated by an AI system based on available data for educational purposes and should not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us. We'll see you next time for the next deep dive.